Welcome back to Intermediate Accounting and today's topic of the statement of cash flows. Today I'm happy to introduce you to a special guest here. We've got Tigger here helping me out on the statement of cash flows. The purpose of the statement of cash flows is to allow investors to try to answer a few questions, including where was the cash spent? How did we receive the cash? And how do we explain that change in the cash balance over the prior year? We classify our cash flows into three categories: operating, or relating to the company's main operations business; investing; and financing. How is financing meaning? How is the company raising cash? Here again, we see the three categories: operating, cash effects of transactions that affect net income; investing, making and collecting loans, acquiring and disposing investments in PP&E; and financing, obtaining resources from owners and providing them with a return on investment, as well as borrowing money from creditors and repaying the amounts owed. Let's write this out because there's a lot to it, and we need to know how to classify all cash flows. So before we get into the three categories, let's separate our transactions into inflows of cash and outflows of cash. If you haven't already, take out some paper, take out a pen, and take these notes along with me. All right, let's start off first with the operating section. Cash receipts related to what the company's in business of doing, its main business. This relates to cash receipts related to revenue. Remember, not all revenues are collected in cash within an accounting period. Cash may be received related to revenues from a prior period or in advance of revenues to be earned the subsequent accounting period. And then cash outflows, this is cash paid for expenses: salaries expense, advertising expense, utilities expense, and so on. Okay, we'll see that there's a little bit of work that we need to do in order to put together to prepare this operating section of the statement of cash flows. We'll get to that next. Now we have the investing category or classification. These are cash receipts and cash payments related to long-term assets. So how would we receive cash in the investing section? Well, when we sell PP&E, plant, property, and equipment, and or investment securities. So debt and equity investments, right? We sell our stock portfolio, we're going to receive cash. And those investments we sometimes say are securities. So sales of plant, property, and equipment and or debt and equity securities. And also, if we as a company act as a lender and we give cash to someone else in order to earn interest revenue, we are making an investment in a loan to somebody else. When they pay us back, that collection of loans made to others, and we would call that from our company, when we're the lender, we would call that a collection of a note receivable. That cash received for principal would be classified as an investing activity. Okay, and on the outflows section, it's just the reverse here. If we receive cash when we sell our buildings and investment securities, we pay out cash when we buy plant, property, and equipment and or investment securities. And related to those notes receivable, when we collect the receipt of the principal from the company that we lent to or the customer that we lent to, we classify that as investing. And when we first lend that cash out, that would be an investing cash flow. So loans made to others when we issue a notes receivable. And then finally, our third category or classification is the financing section. We would receive cash related in the financing section when we issue stock or issue equities. So common stock or preferred stock. If we issue bonds or issue debt, bonds or notes payable, which are simply loans, we would receive cash and classify that in the financing section. And that's it for how we can receive cash related to financing. How would we pay cash related to financing? Well, we never repay common stockholders. We do repay the debt holders with their principal, but we never actually pay back the common stockholders. They give us that money. They don't lend us the money. But if we do make a payment to a common stockholder or a preferred stockholder, we would call that dividends. So payments of dividends would be classified as financing outflows. Repayments of debt, whether it's a bond or note payable, would be classified as a financing outflow. And sometimes we call the repayment of debt redemption of debt. And finally, the other way that we can have an outflow related to the financing section is reacquiring treasury stock. When the company goes out and buys its own shares of common stock from the market, reacquisition of treasury stock. That would be a financing cash outflow. Okay, looks simple enough once we know how to classify all of the possible transactions a company can enter into, but there's a little bit more to it from the operating section. And the reason for that is that when the companies are recording their cash receipts, they're not writing in the books what those receipts relate to in the operating section. So we need to start with net income and then look at how our other income statement items and balance sheet items have changed. So when we're preparing the operating section of the statement of cash flows, we need the most recent year ended. When we're preparing this year's statement of cash flows, we need this year's year-end balance sheet, and we need last year's balance sheet. So our beginning and ending balance sheets, we need the income statement for the current year, and if there's any special transactions that we need to know about, we need to have that information as well. Let's take a look at an example. On January 1st, 2017, Telemarketing Inc. issued 50,000 shares of common stock. The company rented office space, furniture, and telecommunications equipment and performed marketing services throughout the year. In June, the company purchased land for $15,000. Based on this information, we're going to prepare a statement of cash flows. We're going to have the information from the balance sheet that tells us what did the company, how did the accounts change. We also have the income statement. Remember, when we're starting the operating section of the statement of cash flows, we start with net income, and then we adjust for those items that affected net income but did not affect cash, or affected cash but did not affect net income. Here's the 4 steps in preparing the statement of cash flows. Work on that operating section. Start with net income and then make your adjustments to get cash from operations. Then, more straightforward, is doing the investing section and the financing section. And finally, add all that up. Add your net cash from operating activities and your net cash from investing activities and your net cash from financing activities, and that will give you your net change in cash. So let's start here. We have our balance sheet, we have the income statement. We're trying to put together the net cash provided by operating activities. Start with net income from the income statement. And then we need to make adjustments to reconcile net income to net cash provided by operating activities. So what of our current assets and current liabilities, those are the items that relate to the operating section of the statement of cash flows. How do those items change? Well, we see here that accounts receivable increased by $41,000. So what does that mean? It meant that net income was recorded for $41,000, but that cash was not received. Cash received was lower than net income by $41,000. So if we start with this net income of $39,000, We subtract out the increase in the accounts receivable because that represents cash that was not received. What else happened with our current assets and current liabilities? Well, accounts payable had a $12,000 increase. So what does that mean to us? If accounts payable increased, that means that expenses were incurred that the cash payment has not yet been made. So we're going to add that expense, reduced our net income, but will not affect our cash from operating activities. So we're going to add back that increase in accounts payable. We put together the income of 39 and the net increase in payables and receivables, and we get net cash provided by operating activities of $10,000. Next, we need the cash flows from investing activities. We know that land was purchased for $15,000, so we're going to see a negative $15,000 in the statement of cash flows in the investing section. Finally, we're up to the cash from financing activities. We know that at the beginning of the year, the company issued common stock for $50,000, so they received that cash. And the company paid dividends of $14,000 for a net cash provided by financing activities of $36,000. We put together these items that are shown here in red, the cash from operating activities of $10,000, less the cash used in investing activities minus $15,000, and plus the $36,000 cash provided by financing activities to get the net increase in cash of $31,000. And what we're trying to tie back to, if we take a look at the balance sheet, we see cash January 1st was zero, and cash at the end of the year, that net change was a $31,000 increase in cash. What we've done is help the investors understand where was that coming from. A little bit from operating activities. We're investing a bit, but most of that cash came from financing activities, from the issuance of common stock. Let's walk through another example. Kaiser Beverage Company reported the following items in the most recent year. For each of these items, we're going to say, where does that belong? What does it affect? The operating section, investing section, or financing section? Net income is going to be the starting point in the operating section. Dividends paid will be a reduction of cash in the financing section. The increase in accounts receivable is going to be a reduction in the operating section. An increase in accounts payable is going to be an addition in the operating section. Purchase of equipment is going to be a reduction cash outflow in the investing section. Depreciation expense. So that is one item that the depreciation expense would be recorded as a part of net income, but it doesn't affect cash. So when we're reconciling net income back to operating cash flows, we're going to need to add back that depreciation expense. Finally, the issuance of the notes payable, that is going to be a cash increase of $20,000 in the financing section because it was a way to raise cash. We are asked to compute net cash provided by operating activities. In the operating section, we start with net income. We subtract out the increase in accounts receivable. We add the increase in accounts payable. We add back depreciation expense since that lowered net income, but it doesn't affect our cash from operating activities. We get net cash from operating activities of $75,000. We purchased equipment of $8,000. We received $20,000 when we issued a note payable, and we paid $5,000 in dividends. When we add up the $75,000 cash increase from operations, subtract the $8,000 cash outflow for investing activities, and add the cash inflow from financing activities of $15,000, we get the net increase in cash of $82,000. Last question, in preparing a statement of cash flows, which of the following transactions would be considered an investing activity? And the answer is going to be, of course, A, the sale of equipment at book value. Now, before we finish, let's just take a few notes about what are the items that we need to reconcile in the operating section of the statement of cash flows. The investing and the financing is relatively easy once we remember these rules, but the operating section is a little bit more complicated. Remember, we always start with net income, and then we have to adjust. We have to adjust for the changes in our current assets and the changes in our current liabilities, because these are things that affected net income, but not our cash from operations. So start with net income, and then one adjustment is going to be either to subtract an increase in a current asset, such as accounts receivable, or add a decrease in current assets. As we saw, when the company increased its receivables, that means it had recorded more income than it actually received in cash from operations. Okay, what else? We need to, this was the current assets, we need to account for the changes in the current liabilities. So we add an increase in current liabilities. Why? Well, let's say, for example, the current liability that increased was salaries payable. What does that mean? That means the company incurred the expense of salaries, but they haven't made the cash payment. So that net income number here at the top was reduced by the salaries expense, but we're trying to reconcile down to cash from operating activities. We haven't made that cash payment, so we need to adjust to add back the amount that we had recorded as an expense that was never paid out in cash. So we either add an increase in current liabilities or subtract a decrease in current liabilities. Okay, so that's our second adjustment. We may also need to adjust for depreciation expense. So add back any depreciation expense, or when we depreciate or account for the cost or the usage over time of an intangible asset, we call that amortization. So add back any depreciation or amortization expense. And then one more item that we need to account for that we didn't see in our examples is if the company had sold any plant, property, and equipment or investment securities at a gain or a loss, we want to subtract out the amount of that gain or loss. So subtract or remove any gains or losses. So if the company had a $10,000 gain on the sale of a building, we would subtract out $10,000 from net income to remove that gain. Well, what you're probably thinking, what about the cash that we received? Well, the cash that we received when we sold the building is going to go in the investing activities, but we take out any gains or losses on sales of any long-term assets, PP&E, and or investment securities. And once we make these adjustments, these 4 adjustments, if we need to, then we have our cash from operating activities. Cash from or for. We say from if the net cash flow is positive, and for if the net cash flow was negative or an outflow. And that concludes this video on the statement of cash flows. What did you think about this video, Tigger? Tigger says she enjoys it and looks forward to participating in her next video.